Higher mortgage rates and low inventory are some of the big challenges that have been facing the housing market this year, stalling much of the activity really that we have seen over the last several years. Well, now Goldman Sachs is out with its outlook for next year for 2024, and they're warning of more pain ahead. We want to bring in David Mericle. He is at Goldman Sachs, chief economist in global investment research. It's great to see you here, David. So let's talk about the dynamics at play right now in housing, how you see that reshaping, or if at all, the housing market next year. Do you see any signs of improvement on the horizon?
Probably not in terms of either home prices or home sales. Home building has actually proven surprisingly resilient this cycle to mortgage rates that would have seemed awfully high back in 2019. So I think we kind of need to separate the two things out. On the home sales side of things, most Americans now have mortgages at rates that are well below current market rates. So understandably, people are reluctant to move because they'll wind up with a much higher mortgage. And so home sales have fallen quite a bit. We expect those to stay quite low next year. Home building did come down a lot in 2022 as the Fed signaled a hiking cycle. And I certainly think there will be some consequences of the renewed rise in interest rates. I would just say, relative to what you would have normally expected historically from an increase in mortgage rates of this magnitude, the impact this time around has been diminished by the fact that we have a serious national single-family housing shortage. This was something that, at the outset of the rate hike cycle, we thought was probably going to limit the impact. Again, not that there's been no impact. Home building activity did come down last year, but it's still comparable to where it was prior to the pandemic. And that's because if supply is the binding constraint on economic activity, then even bringing demand down a lot by discouraging some fraction of potential buyers from buying at these higher mortgage rates still leaves plenty of buyers in the market and still doesn't affect prices all that much, which means for home builders, if you can build a home and turn it around and sell it, that's still pretty attractive. So we're looking for home building to be roughly flat next year, home sales to remain at a quite depressed level.
Yeah, we were speaking about this just a few days ago and looking across the backlogs that many of the home builders still have that they're working through and where some of those new orders are continuing to flow in, even if it is decelerating. One of the things that we are continuing to monitor as well is where potentially there needs to be more decline. And I would love to know from your purview where the prices need to decline further for a lot of home buyers and prospective home buyers out there to feel like they can effectively offset where rates may be at right now.
Well, I think prices are unlikely to decline meaningfully precisely because of the supply shortage. I would distinguish a little bit between the single family market and the multifamily market. On the single family side, by most estimates, we have a shortage of many millions of homes because we've made it somewhat difficult to build in many places that people want to live in this country with zoning restrictions and things like that. The multifamily supply response to high prices, though, over the last couple of years has been much more forceful. And indeed, we've seen a lot of completion of multifamily units, and we have a huge number of multifamily units that are still in the pipeline that builders want to finish up. So we have made more of a supply impact on the rental market, and that has helped to slow growth of rents. But it's just very difficult in a short period of time to have a equally appreciable impact on the single family market. And in fact, we've seen the homeowner vacancy rate fall even a little bit further to now a historic low. So primarily for that reason, you're absolutely right that affordability has diminished substantially. First, prices rose a lot, then mortgage rates rose a lot. It costs an awful lot more to finance owner-occupied housing than it did several years ago. But because of the supply shortage, I think the demand is still there for the market to clear at prices similar to where we are. So we're looking for a small dip in prices in reaction to the big move in rates that we've seen this year, but then a small uptick next year. So no major changes from here.
Yeah, David, we got to hustle to our finish here, but ultimately, when you think about the kind of turnover on a market basis because of the zoning that you were mentioning, are you expecting there to be another wave of perhaps migration into different markets where affordability is that much more attainable for prospective home buyers?
I think that's a reasonable conclusion. For people who don't have homes, that you might see some migration toward cheaper markets when people get to the stage of their life that they want to buy a home. For people who do own a home, who do have a mortgage, in general, they're paying a much lower rate than is available today, so they're sort of locked in. But the people who are renting, who want to transition to buying, given the high level of prices and given the impediments to building more housing in areas where prices are very high, I think it makes a lot of sense that we'll continue to see migration toward lower housing cost areas.
David, where do you see mortgage rates at the end of next year?
Similar levels. We don't have the Fed changing policy until Q4 of next year. And I think the increase in long-term interest rates that we've seen recently, which is of course spilled over to the mortgage market, has probably come from things that are likely to persist. Number one, I think the market has substantially reevaluated what it believed last cycle about the longer-term neutral or equilibrium rate. And number two, possibly there's been some increase in term premia as well. Until the Fed cuts or until something interest rate related seems to go wrong in the economy, I don't see a lot of obvious reason to expect meaningful declines there.
All right, excellent work here, and thanks for bringing this to our attention here. Some of the work that you and the team over there are doing. David Mericle, who is Goldman Sachs chief economist in global investment research. Appreciate the time here today.